Welcome back to another episode of the Know Better, Do Better series. Chloe and I have been having so much fun bringing you these episodes. We've got a few more left, and today is going to be full of all kinds of fun stuff. So, as you know, at the top of every episode, we do a series called Trends, Taxes, and Tea, where we're sharing with you either the latest trends on how to save more and pay less, or we share some current event that has to do with money. Today's trends, taxes, and tea. I mean, Chloe's really good at coming up with these. I'm not even going to tell you guys a lie. She does it every single week. She finds all the goodies. So Chloe, take it away.
Thank you, Lauryn. Yeah, I'm probably really good at this because I spend way too much time on social media. but yeah, so this last week, a TikToker recently decided to casually make a scam coin online. And scam coin stands for Simple, Cool, Automatic Money. And so he created this online just out of thin air and didn't advertise it. And it reached about $70 million market cap within an hour.
What?
So, yes.
In 60 minutes. Wait, so what is market cap for those who are listening and have no idea what that means?
Yeah, that's basically just the size, like essentially the size of an investment. And so yeah, it reached the 70 million in an hour. Within 10 minutes, it reached 6.6 million. So yeah.
So somebody literally woke up one morning and was like, I'm going to create something called scam coin. But you're saying it's not in fact a scam. It's just something legit.
Yeah, it's a cryptocurrency he created it he created it, so he made it up. So I wouldn't say it's legitimate, but yeah, he created the scam coin and people just started investing in it. And so he posted a video. The reason why it was so well known, he posted a video on TikTok and it was uploaded to Twitter. And he was like, "Hey guys, I just created this little Bitcoin, over here, and didn't advertise it and see how much it's worth." And he was himself in disbelief. Yeah. But
are these people able to cash out on what they put in, or is this completely money that was thrown into a black hole and it's all going to be lost?
Well, yeah. So that's debatable because as you know, a lot of this activity helps to drive the price up, and so at some point people have to get their money back out of the investment. If everybody tries to get out at the same time, of course, then that's when things kind of crash. But yeah, I mean, similar to like the GameStop phenomenon that happened earlier this year. But yeah, I mean, the bottom line here is that dozens of cryptocurrencies are launched each month. Investors are very much willing to throw their money away towards highly speculative cryptocurrency, and it's a prime place for scammers. So just make sure that before you invest in cryptocurrency that you understand what you're investing in and that it's legitimate. And just try not to chase returns. Otherwise, you can get burned.
And that's a great segue to our topic today, investing. So in case you couldn't tell from what we were talking about as it pertains to trends, taxes, and teas, that is what we're going to be talking. And this is kind of a 101. So many people are interested in investing, but they can't figure out how to get in, where to get in, what they should be investing in, all these little things. And it gets a little bit overwhelming. So people either do nothing or they make poor investment decisions. So today we're going to be just covering those basics. And Chloe, I'd like to start with just asking, why is investing important?
Yeah, I think investing is important for two major reasons. The first is that it helps your money grow faster than just saving alone. I know when I grew up, I was taught that you should save your money for a rainy day. You should put your money in a savings account. We all learned about probably CDs, and savings accounts growing up. But I didn't learn a lot about investing, and so that's actually a better place for money that you want to have to grow in the long term, and it gives you a better chance of achieving those long-term financial goals. The second reason is that investing is a way to make your money work for you. Everybody talks about making their mony work for them.
I've heard it a million times. If I had $1 for every time I'd heard that,
yeah. We would be rich. but yeah, investing is definitely a way to make your money work for you, and it does that through what's called compounding. And that's just, interest on top of interest on top of interest. And it really helps your money grow exponentially over time.
I love it. I love it. So that is why investing is important. But now we need to talk a little bit about like how to get started. So like, where do I start? And you guys are not going to like me a whole lot, but I am going to say it anyway. We need to first cover the basics. So before you dive into the great big old world of investing, you first need to look at your financial situation. So understand what you're contributing to your 401k. First, I mean, even to take a step back from there, your budget. So the big bad B word comes into almost every single episode, because if you don't know what you're earning, then you don't know what you can save. And if you don't know what you're spending, you don't know where your money is going. So yes, you have to have a budget, but also, on top of that, when we're thinking about the basics, are you contributing to your 401k? And at least, now mind you, big emphasis on the word least, are you at least contributing to the employer or contributing up to the employer match for your 401k? So as an example, your employer may match 3% of whatever you put in. So if you make $100,000 a year and you pick 3%, $3,000 of your money is going to go into retirement, and then $3,000 of the employer. So you actually save $6,000 for the year. So awesome thing. One of the biggest things I see people running into is choosing not to participate in their 401k at all because their employer does not match. So the employer matches become super duper trendy. It is an awesome thing. You should take advantage of it. But just because your employer does not have a match does not mean you don't need to put money in your 401k. And then above and beyond that match, you need to think about, can I put the maximum into retirement? So the maximum is $19,500. So a lot of people don't realize that they can do more than 6% or 3% or whatever that match is. And you've got to be thinking about, what is the amount that I need to save in order to be able to retire on time? Go ahead.
Yeah, definitely. I talk to a lot of people and they're like, oh, I'm maxing out my 401k. And I'm like, how much are you putting in? And they're like, oh, just up to the company match. And I'm like, well, that's not matching. That's not maxing out.
Yeah, maxing and matching are not the same thing. And I think there's definitely someone listening who's like, really? We hear it all the time. You are not alone, but it's important to know that, there's two different things. And one is likely not going to get you enough to be able to retire. The other is going to give you a much better chance. And that's the maximum. Also, I wanted to say, as we're thinking about the basics, to make sure you're setting some money aside for a rainy day. Make sure that you don't have credit card debt. So that is high interest rate debt, 23, 29. I've seen some really awful interest rates as it pertains to credit cards. And a lot of people are so eager to get investing that they skip over something that, is giving you a big red flashing sign that says, hey, you're not in good financial health. Deal with me. I'm only going to continue to get worse. I'm compounding in the opposite direction. So please take care of your credit card debt. Make sure that you have an emergency fund of some sort, rainy day fund, poop hit the fan fund, whatever you want to call it. Some people call it the FU fund. You want to have some dollars set aside should something happen, COVID part 2, and then think about what you want to do. Chloe, what else should we be considering as we think about how to get started?
Yeah, and even with covering the basics, people say, oh, I want to invest. If you have a 401k, you are investing. Mm-hmm. That's the easiest way to get started investing. So you have investment options that your employer provides that you're available to choose from. And so that's really the simplest and easiest way to get started with investing.
Yeah, very, very simple way. Like I said, so many people don't realize that you don't need to open an investment account. You have one right at your employer. No need to be a guru. Just start putting money in it. The other thing I would say is know your why. So, you need to understand why you want to invest and what the money you are saving is for. Now, there's two important considerations. So, Chloe, do you want to kind of clue us in on the two things you should be thinking about when we're thinking about knowing our why?
Yeah, I think the first thing is just, do you need access to this money if you fall on hard times? So that goes back to, what Lauryn was saying earlier about having, money for a rainy day and an emergency fund. If this is money that you'll need, immediately, if something were to happen, if you were to get sick, if you were to lose your job, if you need a new roof on your house or need some repairs done to your car, that's money that you really shouldn't be investing. So just, think about the time horizon and how quickly do you need access to that money. That money needs to be in cash. If you invest that money and the market goes down, which at some point it will, and you need to sell it, when the market's down, then that's not a great situation to be in. So, just make sure that you think about how long it will be before you need that money.
Yeah,
And then also,
I just wanted to circle back to something you said because, you talked about like purchasing a home. One of the things I hear frequently is people pulling money out of their retirement account to purchase a home. How have you seen that historically play out for people? And, what circumstances is it maybe okay or not okay to pull money from your retirement to take care of a home or to purchase a home?
Yeah, I think pulling money out of a retirement account should be a last resort for any reason, honestly. If you're doing the right things, like Lauren said, the big bad B word, budget. If you're budgeting, if you're saving for a rainy day, if you've built a habit of saving on a regular basis, then you should be able to save up enough to put something down on a house. You don't want to pull money from retirement unless you absolutely have to, and it's just, like I said, a last resort, because basically you're just robbing robbing money from your future self, essentially. And that's money. Just think about how much longer you'd have to work or how many more years you have to add on the back end to work and continue saving to make up for that money that you're taking out today.
Yeah, no, I think that's a really good point is, you want the home and you want to have the home. Maybe it becomes urgent for, one reason or another, but, is it worth having the home and retiring 4 or 5 years later? As long as you can, confidently answer yes, then, maybe it's something where you take, but know that you're taking away from something that you admit for the long term.
Yeah. And then also just think about in addition to money that you need right away, and there's kind of, intermediate type money. So is there money that you might need in the next few years? Let's say you are saving to buy a house or for some goal that's maybe a few years away. That's still money that you should keep, in cash or pretty conservatively invested. And then anything that you'll need, that you're saving for retirement that you probably won't touch for at least 10 plus years, that's the real money that you need to be investing. And so when we talk about, a lot of times, we'll talk about mindset and making sure that, you're in the right mind to invest. And people freak out when the market goes down, or they're like, oh my God, I've lost all this money. You haven't lost anything until you've sold it. So if it's money that you're not going to touch for 10, 20, 30, possibly 40 years, and the market's down, it doesn't really matter because you're going to have time for the market to come back up. And over an extended period of time, 10, 20, 30, 40 years, you're most likely going to end up with a lot more than you started with. So if you have those things in place, like your emergency fund, and you have cash set aside that you'll need in the next few years, then, having the market going down, it's not going to affect you much.
Yeah. So time horizon is what Chloe is referring to. When do you need this money by? And I think that you just drove the point home so well. So many people were, COVID. I mean, it was a really scary time for all of us. But when we make reactionary decisions in moments like that, we really, really can mess things up. And if you were already planning on that money for 30 years from now, then what was happening last year or any other dips that come up in the near future, you shouldn't be shook by those. You should be, business as usual, doesn't ruin my plan. Which kind of brings to the next point is really understanding the risk that you're willing to take on. So first, what risk is, how much problematic possibility are you willing to take on in order to achieve a certain amount of reward? So if you're not very much into taking on risk, then you may do something more conservative, and realizing that by you're doing something more conservative, you're probably going to get less reward and being okay with that, which means you might need to save a little bit more. So somebody may save $300 a month and be very, very risky and end up in the same place as somebody who saved, $500 a month, but was less risky. You can get to the same place. You don't know what's going to happen. And obviously with risk, you could end up, with less money than you started out as. So that's one thing to be considerate of. Chloe, what do you think about risk?
Yes, like Lauren said, it's important to understand how much risk you can personally handle, and then also think about how much risk you need to reach your goals. I think a lot of people are lured right now to certain types of investments. We talked about cryptocurrency earlier. People talk about, investing in individual stocks, just different, even rental real estate, just different types of investments. But, you should understand, if you're going to invest in something that's super risky, do you need to take on that much risk? Maybe you don't need to because you're saving so much. And you can afford to take like the simpler road, or kind of the middle of the road type investment. And so just understanding, kind of what you're willing to take personally, and then what you need to take, and not taking any more risks than you really need to.
Yeah. I mean, and the other thing that's important to note is that all investments have some level of risk. So whether you're, I'm 100% out of the market, I don't want anything to do with the stock market, and you're just going to do real estate. Well, real estate has a risk. We've seen the housing market go upside down. People have had bad landlords, people have had their house catch on fire. You name it, you're taking on risk. Risk is simply that unknown thing that is going to come around the corner, and affect you in some way or another. And so how much of that unknown are you willing to take on in order to gain some potential reward? And
and even cash and bonds, there's risk associated with that. If you have cash, you have the risk that the inflation is going to grow higher than the cash that you have sitting there, the interest rate on the cash that you're earning. Bonds, they can lose value. So yeah, just everything has some level of risk. It's just the type of risk.
Yeah, I think that's a good point. Some people are like, I'm just going to stuff it in my mattress. That's kind of the cliche term that we hear. But the idea is that, if you stuff 50 grand in your mattress now and you wait 20 years, your 50 grand is not going to go that far. You might buy 2 loaves of bread with that $50,000 and you're like, oh man, I wish I would have invested to keep up with inflation. So,
yeah. The next thing is just keep it simple. So I talk to people all the time, and I'm sure you do, Lauren, that have multiple bank accounts, multiple investment accounts, multiple credit cards. I think the most I've seen is like maybe 10 different bank accounts, like 13 investment accounts, 6 different credit cards. But there's no way that you can have a handle on your finances and manage what's going on in your world if you have that many accounts. And even with investment accounts or bank accounts, if you have accounts at 4 or 5 different institutions, it's just super hard to understand what's going on. So, Leonardo da Vinci said, "Simplicity is the ultimate sophistication." And so, just think about that and make sure that you can manage your finances in a simple way.
Yeah. I could not agree with you more. Having accounts here, there, and everywhere, and having them remember and keep up with things, one, creates a problem of, wealth transfer when it's all said and done. So a lot of people are like, well, I got, a little bit of crypto over here. I've got, a brokerage account over here. I've got an app that I'm investing in over here. My 3 old 401ks from my job. When we talk about simplicity, it's about like rolling those things together, keeping it as tight as possible, keeping them all in one place so that you don't forget about something. I've actually had clients completely forget about 401ks. They're like, oh yeah, I worked at that place. I think I was putting money in. And I'm like, well, let's go do some research and find out. And you find out later that there is some additional dollars that were left behind. So, and 38 bank accounts too. I have to throw this in. You were talking about number of accounts that you've seen. 38 bank accounts is the most. Your bank accounts are not your budget. There is this thing called the bucket budget where, you kind of use the bank accounts as buckets, but you don't create a bucket for hair, a bucket for nails, a bucket for shoes, and so on and so forth. You don't want to make so many bank accounts that you're using each of those items, and it's really hard to manage. There's a lot of fees associated when they get empty, which debit card do you use, etc. So keep it simple. Definitely couldn't drive that point home enough.
Yeah, definitely. And then we'll talk next week too. And I know there's only so much consolidation that you can do, with different types of accounts, because there's, traditional accounts, there's Roth accounts, there's, regular brokerage accounts, savings accounts. But we'll talk more about the types of accounts next week, and kind of how to prioritize those and just, but the idea is just to keep it as simple as you can.
Yeah, we're going to do the stop, drop, and roll episode. I just made that up right now. I feel like it's a good one because you got to roll over your IRA, Okay, that was a corny joke. Most people probably don't even know what I'm talking about. So last but not least, diversify. So when we talk about the investment basics, you definitely need to make sure that you are diversified. So now more than ever, like I said, people are getting into the trendy stocks. The whole GameStop thing kind of set the world ablaze earlier this year, and it's gotten even more popular. But you really want to look at something that's going to be well diversified, being a little bit of everything, so that when one thing goes down, something that is opposite of that thing can go up. If you only have one thing, you're dependent solely on that company to do an excellent job. And if they don't, you've lost everything or as much as that company has lost. So be very, very careful about what you choose to invest in. So what do you think of when you think of diversifying, Chloe?
Yeah, it's the good old saying, like don't put all your eggs in one basket. And I working with a lot of tech clients. I see this all the time. Where clients have majority of their investments in their company stock, and let's say they switch jobs a few times. They might have 2 or 3 different companies, that they have stock in from previous employers. And so that's something that's super risky, when you have all of your money into a single company, especially if that company also pays your paycheck. Because if something happens to that company, if they go down, not only do you lose your life savings, but you lose your job in addition to it. So yeah, I think when it comes to diversification, you want to look for things like mutual funds or exchange traded funds, which are, people call them ETFs. They offer a little bit more diversification than individual stocks. So, for an example, with a mutual fund, it could be a single fund that invests, and a manager manages that fund, and that fund could invest in 100 different stocks. And so they might have different, goals. It could be like a fund with all large companies or all international companies. But that just owning that fund instead of owning an individual stock automatically gives you that level of diversification. Yeah. And then some exchange traded funds might follow an index, like you might hear about like the S&P 500 index. And so you could buy an exchange traded fund that follows that index. And so it kind of mimics, those 500 stocks. So yeah, just, thinking about having some diversification is always good.
Yeah. And as I think about it, sometimes, people's eyes might be starting to glaze over. Hopefully you're not driving, listening to this podcast. You're like, I'm overwhelmed. I don't know what's happening. But this can be a lot. And instead of wondering which mutual fund, which ETF, which, account do I open, all these sorts of things, there's these things called robo-advisors now that kind of automate the process for you. So one of the ones that I kind of recommend to people a lot of times, and they're not paying me to say this, is Betterment. It's very simple because it's like, hey, what's your name? What are you saving for? And you click the little button that says retirement. When do you need this money by? Are you a business owner? Yes or no? And they just kind of make all these kind of, which account do I need and what's most appropriate for me? Take all the guesswork out of that. And then you can kind of set it and forget it. So you don't need to worry about what they are. They do invest in ETFs at Betterment. So it's low cost, well diversified, and it will get more conservative as you get closer to whatever time frame you're trying to use those funds for. So if all of this is a bit overwhelming, there are still easy do-it-yourself options where you don't need to be taking on a lot of risk or trying to pick the right stocks that can still get you properly diversified and where you want to go.
Yeah, and even in your retirement accounts through your job, you probably have what's called target date funds, and so that's another quick and easy option. If you're just getting started, but you might see like a Vanguard 2050 fund, and so that means that you anticipate retiring in the year 2050, and so you pick that fund, and what they'll do is they'll create a diversified portfolio for you, and then as you get closer and closer to 2050, your target retirement date, then that fund will get a little bit more conservative. And so that's just a really quick and easy option that's available to kind of help you dip your toe into investing.
I love it. I love it. I love it. So the last thing we want to really talk about is this idea of public investments versus private investments, because there's some, like I said, misnomers and misinformation out there about like what the different types of investment options are that are available to you. So when we say public, we think of things that are traditional, like stocks and bonds. You can purchase on the market through a brokerage account. Like I said, they're in your 401ks. They're these various apps that you're using. They're relatively liquid, so you can easily say like, I don't want to have Apple stock anymore. I'm just going to sell it. And you go ahead and you hit the button, you sell, and you're done. You get your cash back and you can move on with life. And there's a lot more visibility around these different companies so that you can be participating. So like I said, the trendy companies that are out there this year, you know, people are talking about these car companies and tech companies and things like that, and they're investing in them individually. Like I said, ETFs, mutual funds are also part of the public market where you can invest and do trading, but also you don't need to be wondering about, like you said, what's in there, what's not in there. But that's what we refer to as the public market, is these companies that are publicly known and publicly traded.
Yeah, and when you're doing if you do buy individual stocks, you know, which like we said, we don't necessarily think that's the best idea for starting out, but you know, you can have that visibility in the sense that you can look up the earnings, you know, for the company, and you can do your research on the company and see if it's really a good investment. And same thing with mutual funds or ETFs. You can see, you know, who manages these funds, and you know what's their track record, and information about, you know, like their specific funds. And so that there's a lot more visibility with public markets. With private markets, you know, typically I think about, you know, kind of private equity, private debt, and private real estate are the main three categories. Private equity can mean, you know, venture capital for startups and early stage companies, or even more established companies, and, you know, private debt, and then, you know, private real estate, you know, just being regular real estate that you buy into, whether it's commercial or residential. And so generally these are not as liquid. So, you know, your money can be locked up. They're not valued as frequently. With public investments, you know, stocks or mutual funds or bonds, you know, you can see the value of those on a daily basis. And in some cases throughout the day, you can see how the value changes. But, you know, these private investments aren't valued as frequently, so they can be seen as more risky. And they're also not subject to the same level of regulatory scrutiny as public investments. So, you know, a lot of times I know there's a lot of talk now about venture capital investing, and, you know, investing in some, you know, maybe commercial real estate, or, you know, just different like debt funds. But a lot of those super high quality investments that, you know, that have a track record, or have managers that have a good solid track record, they're typically only accessible to high net worth investors. And so there's a couple of different, you know, categories that you can be in to be considered high net worth, but just, you know, the things that are private that the average investor can get access to are probably, you know, they might not be as high quality and as vetted as a high quality investment that could go to a high net worth investor.
Yeah, and I think this whole idea of, like you said, not being liquid, so like I said, that's a huge deal, and it's something you need to plan ahead for. So if you choose to go into something that is private, like you said, a house as an example, a lot of people want to, you know, do passive investing and, you know, be a landlord and things like that. So, you know, there should be income coming from whatever rent you're collecting. But if there's no rent being collected, you can't just dip into a cash register of the house and take care of the mortgage, because the only cash register is the actual mortgage, and, you know, or your equity that's in that house. So just be mindful that you can't get the money out unless you actually sell the house. So that's a really good example and a really good thing to be mindful of as you think about this private equity. The other thing I wanted to share is that I'm actually in a venture capital class right now, because I wanted to learn more about this topic. So, you know, I am definitely a fan of just nice traditional public investing. That's what I do on behalf of my clients. But, you know, as part of Know Better, Do Better, I also have to know better so I can speak more intelligently about these things. And even if I'm not interested in venture capital, once this is all said and done, I'll be able to articulate a little bit more about why I'm not. And I do also know, like you said, that with it being private, it's going to be only accessible to some higher net worth individuals. And as my clients continue to grow their wealth, they might run out of places to put money in. You know, maybe we need to start looking into some of these alternative things.
Yeah, definitely. And there's definitely a place for private investments. I think it's a good complement to a public, you know, portfolio, but you know, it's a portion of the portfolio. So once again, don't put all your eggs in one basket. And then I wanted to talk too quickly about just alternative investments, because a lot of people, you know, throw that word around, alternatives. So basically that's something, an alternative is something that doesn't correlate directly with traditional stock or bond markets. So if you're investing in alternatives, and it's kind of a broad range of investments, but the goal is to provide just an additional level of diversification and potentially, some protection against losing money in your traditional portfolio through that additional diversification. So there's kind of different types of alternatives. Illiquid alternatives are kind of the private investments that we were talking about, because they might not necessarily correlate with stocks and bonds and go up and down at the same rate as stocks and bonds. But there's also some liquid alternatives. So there are mutual funds or ETFs that invest in alternative assets. So a good example of that is like a real estate fund. There are mutual funds or ETFs that invest in real estate. And so you don't necessarily have to go out and buy physical property. You could invest in a real estate fund. And there's other types of alternatives or different strategies that managers put together to help kind of complement what you're doing with traditional investments.
Yeah, I talk to my clients about this all the time. The idea that you just said about real estate being something you can buy into without having the hassle of being the landlord, purchasing the home, maintaining the home, selling the home, etc., so on and so forth. So great alternative way to be able to participate in something you're interested in without actually having that, responsibility hanging over your head. All right. We just wanted to, like I said, cover the basics today. We don't want to overwhelm you. Obviously, investing is a very, very deep subject. We could go on and on for 6 or 7 episodes, but we're going to try to wrap it up in 2 episodes. So today, as we think about the final takeaways, your best investment strategy comes after you understand your full financial picture. So understand what you have going on, understand what's coming in, what's going out, set some goals, know when you want to retire, why you're investing, and those things will start setting the course for what should I be investing in. Chloe, what other takeaways do we have?
Yeah, along those same lines, try to make sure you're not kind of winging it and Googling for answers or searching on social media for investment advice. That can be very risky, especially when it comes to managing your life savings. We've talked so many times about, just make sure you understand your entire situation. Don't get caught up in all the trends or trying to, flip your money and all those things or make these quick investment returns. But just really, kind of understand what you're getting yourself into.
Mm-hmm. Also, I would say don't invest in anything you don't understand. So another thing that I'm seeing, like you said, as there's all this stuff on the internet, is people enrolling in a course. I'll teach you how to invest. You enroll in the course, you maybe take the first 30 minutes of it, and then you're off and running, and you go buy a whole bunch of stock, and you didn't really actually pay attention to everything that was offered to you. You didn't spend significant time. You didn't invest enough time, if you will, to really understand what you were doing, and you end up in a tricky situation.
And then people, there's a lot of trendy things going on. And in addition to cryptocurrency, I've seen people, talking about options trading and Forex and just all these different things. If you don't understand how any of this stuff works, maybe it's not a good investment for you. Mm-hmm. And just stick with the basics for now while you're getting started.
Yes. And, the last thing I'm thinking of is you have the ability to save. You have control over your ability to save, but you do not have control over what happens with the market. So start out by really understanding what your ability to save is and realize that the market is a vehicle to help your investments grow. So you cannot out-earn bad spending habits or bad savings habits. And that's what happens a lot of times. It's like, oh, I got these $3. How can you turn it into $300 for me? And it's like, you could have had $300 yourself if you had saved $300 and we set it aside and didn't need it. And that $300 could be growing somewhere. And last but not least, the sooner you start, the better. So the sooner you start saving, the better off you'll be. The sooner you have saved enough that is, your emergency fund so that you can get to the investment part of things, the better off you'll be. So start saving, use investments as a vehicle for your saving. It will, make your money, make my money work for me, all these kind of cliche sayings, but you first have to set about the business of saving. So with that, I'll bring us to today's money quote. It is, don't look for the needle in the haystack, just buy the haystack. Chloe, can you break it down for us?
Yes, and that quote's by John Bogle, who's the founder of Vanguard. So I know we've all heard of Vanguard, but yeah, it's basically talking about, instead of buying individual stocks, which is the needle in the haystack, you can buy an index fund, or a mutual fund, which is the haystack. So, once again, just try to diversify. Don't look for those individual stocks that you're going to get a home run with, but try to diversify your investments and buy a little bit of everything.
I'm going to do a daily double, actually, because there's another quote here that I really, really like. And it says that investing should be more like watching paint dry or grass grow. If you want excitement, take $800 and go to Vegas. So, yeah, break that one down for us, Chloe, because I think this is the one that, like you said, people are just like, oh, that's gross, Lauren. I don't want to. But I think this is so true. What do you think?
Yeah, I think it's one of those things that, we talk about it all the time, get the concept of getting rich slowly. When you make fast money, a lot of times it doesn't last, or you tend to lose it pretty quickly because you haven't invested those habits that it takes to really maintain that, that money that you've made. So, a lot of people are wanting to flip their money. They want excitement. They want, investing to be exciting. But excitement is gambling, which is like this guy says, going to Vegas, or trading on your favorite investing app with individual stocks. But real investing should really be like watching paint dry or watching grass grow. It's pretty boring. It's pretty mundane, but it works.
I love it. I love it. I love it. All right. That wraps up part 1 of our investing series within the Know Better, Do Better series. Chloe, what are we talking about next week? Like, this is part 1. What is part 2 going to bring us?
Yeah, so part 2, we're talking about different types of accounts and different strategies. So we'll talk about types of investment accounts that are out there, how to prioritize with all the different types of accounts that are out there, which one should you contribute to first, and kind of, how to think about the priorities there. And then also, if you don't have a 401k at work, what do you do?
Oh, yeah, that's a really good one, because there are a lot of people who don't. I know I run into it all the time with doctors, chiropractors, dentists, and private practice. Yeah, and there's tons of other people as well that don't have 401k. So, all right, that is a wrap, good people. As always, if you have questions or suggestions for guests, please do not hesitate to reach out to us. You can find us at worth-listening.com, or you can email us at podcast@worth-listening.com. I am Lauren Williams, co-hosting with Chloe Moore, and this has been the Know Better, Do Better series. Until next time, talk to you later.
Bye.